markets go up, they go down. When they go up, that's what we call a bull market. And right now we're in a bear market. So what do? Welcome back to episode number 6, to the Facts of Life, where on every episode, the acronym LIFE means something different, depending on what we want to talk about on the episode. Today, we will be talking about lending and investing. We're going to be talking about family and education. So let's begin. Right now, our market in the mortgage industry is so volatile. There's just a lot of things going on. And just to bookmark, we are sitting here mid-April 2025. And what's going on is all the volatility from all the tariff, negotiations and cuts and rises from other countries. When there's the unknown, there's a lot of volatility. So that affects the stock market, that affects all of our bonds, that affects a lot of our bank accounts in many different ways. So, one of the things that you could do, again, I'm a lender, so on a daily basis, I have a lot of people calling me, just, old customers, new ones, to seeking advice. What do I do with the volatility? And the first thing that I would always have people assess is, what kind of loan do you have today, right? Do you have a adjustable rate mortgage? Do you have maybe a higher rate, or do you have a rate that, may sound good, but, looking at your overall situation, it could be better. So for example, if you bought a home in 2023 or 2024, well, if you bought a home or got a new mortgage, rates were high. It was at the highest point that we had seen in quite some time. So right now would be a really good time for you to assess if lowering your interest rate or refinancing is a good time for you. The first thing I would do is look at, the rule of thumb. There are 2 rules of thumb that we have been using in our industry for quite some time. Some of you may disagree, or some of you may use a different type of strategy, but what I've always been advising or consulting on is this. Whatever your interest rate is, let's say you got a 7.5% interest rate in 2023. And let's say that you have the option to reduce your rate by 1%, but there was closing costs and you have to account for all that. As long as you break even on all the costs and the fees in less than 24 months, which is what we call the break even period, you should do it. However, if you have the opportunity to reduce your interest rate simply by 0.5%, but there was no closing costs, it was covered, or it was like a no cost loan, you should still do it. Why wouldn't you? It's a free loan, right? You're not paying anything. You're not losing anything. So even 0.5% would do you very good as long as there was no cost. So if you either have an opportunity to reduce your interest rate by a full 1% rate, but it'll cost you some money, look at it. You should consider, do the math. Don't just sit and not do anything. That's not smart. I get people who call in and they said, when I was buying my home in 2023, it was such a strenuous process and I don't want to do this again. Well, it's different. If you've never owned a home and you're trying to qualify, it's going to be harder because you don't have any history. And now if you've already owned a home, it's been, 6 months, 12 months, whatever the amount has been, and you have good payment history, you've owned a mortgage, you know what it's like. Refinancing is a lot easier and it's a lot lower in cost compared to doing a purchase transaction. When you're doing a purchase transaction or you're buying a home, there's so many people involved. There's like the title, the escrow company, you got the listing agent, buyer's agent, seller, you're the buyer, you got your lender, loan processors, transaction coordinators, you name it. There's so many people involved. And so it takes a lot to coordinate all of that. But when you go and want to refinance just to lower your interest rate, it's a lot more simple. You don't need everybody involved. It's just you and your lender. So the fees are lower, the process is quicker, and it's less stressful. That's for sure. It could be, depending on your new situation. If your situation was better when you bought your home and now it's like you've lost income or, things have happened, maybe it can be a little challenging, but picking the right lender who knows what they're doing will make it easier on you. Also, another thing that we need to talk about is credit card usage and utilization across the nation is at a very high point right now. A lot of people have been using credit cards. There's been a lot of personal loans. I mean, I come home on a weekly and will open up my mailbox, and I think I get like, I don't know, 12 credit card or personal loan offers every week. Just all in my mailbox, all in my mailbox, and from Credit Karma offers and from just whoever, right? Like, I mean, emails, I'm getting all different kinds of offers. So, with that said, if it's easier to get credit, a lot of people are charging. I don't use credit like that. For me, I use credit cards like cash. So I'll charge to get all the benefits, right? Points or cashback bonuses or whatever the benefits may be. But I pay it all off. I pay my credit cards every single week. So I charge, but I pay it off as if it was like a, not a credit card, so that I don't pay any interest, number one, and I don't have this debt that just keeps on growing. Now, we don't all have the same situation, and sometimes you need to use your credit cards to survive. However, if you have a bunch of credit cards, I mean, look at your statements. You're probably what, 20% minimum APR? Up to the 30s, you know? And if you have the opportunity right now, you have a home, okay, great. You have a 5% rate, and rates today are going to be 6.5, let's say. Yeah, you're right. It's higher. It's 1.5% higher. However, again, every situation is different, right? If you just want to keep a low interest rate on your mortgage, I don't know, for bragging rights or so that you could feel better about yourself, but it doesn't do you any good or it doesn't benefit you, what's the point, right? Like, that's ego, that's pride. We got in trouble in 2009. Homeowners were in the same situation, but they were using the equity in their home as an ATM machine. Every year they'd refinance and pull out cash to spend or pay off debt, and then they would use your credit cards again. And next year, redo it all over again, and just it would just be habitual. Well, that's not what I'm talking about. That's a problem. I'm talking about if you have a set amount of credit card debt that you had to spend or use to get you through some tough times or whatever it may be, to pay for something, to upgrade your home or to pay for something for your kids. And it was a one-time deal and this would benefit you now. Get rid of the 5%, because if you refinance your 5%, but you throw in all these, whatever it is, 30, 40, $50,000 in credit cards, that you're paying 20, 30% of interest on, guess what? Your overall benefit, number one, you'll lower your monthly payment significantly. For two reasons. You're lowering the interest rate, but you're financing your credit card debt and adding it to a 30-year loan. And with that said, if you don't want to touch the first, those that have a 3%, 4% or below, and it's not worth it to touch, look at a HELOC. That's a second mortgage that you can get. It's still like 8%, but you can consolidate all of your credit cards. Not only will your credit cards be all paid off, your credit scores will shoot up like crazy because your utilization ratio will be very low, but you don't have to touch your first, since you have a really, really low rate. So that's an option as well. And then, I'm getting a lot of calls, not a lot, but I do get calls from customers who are like, hey, I want to refinance. And since rates have dropped right now compared to how they've been the last 2 years, I would like to explore doing a 10 or a 15-year loan. And I'm like, why? Why do you want to do that? Number one, if you're a business owner or if you have variable income, right, I would not recommend that, because you never know what's going to happen over the next 10, 15 years. Instead, why not refinance into the lowest 30-year fixed loan? Give yourself flexibility, that option of having a lower payment. And if you have more money to spend, go ahead, make double payments, make higher payments, pay more towards the principal and beat the interest rate. Now, this is not technically or mathematically correct, because it doesn't work like this. When you amortize a mortgage or any other type of loan for that fact, you actually pay more interest in the beginning and less principal. And then as time goes by, usually after the 5-year mark, you start paying less interest in your monthly payment and more principal. But hypothetically, let's just talk about this. So if you get a loan at 7% and it's a 30-year loan, the bank only collects the whole 7% in interest, right, from you if you kept it for 30 years. What if you kept it for half that time because you paid it off early? Does it mean that they only made 3.5% of interest off you? Not really, because it's based on a curve. However, it's a lot lower than 7%. It's less than 5. You got to do the math and configure that yourself to see what loan you have and how that works. But hypothetically, just looking at that concept from a very general view, you have to agree with me that if you don't keep your loan for 30 years, the bank doesn't make interest off of you for 3 years. Therefore, you get to control how much interest you pay on the loan that you want. So why do a 15-year? Now, if you really have a low loan balance and a 15-year loan, like let's say you owe 100K and you do a 15-year loan, it really doesn't have a big effect on your monthly payment, go for it. If that's what you want to do, that's fine. Because 15-year loans do have lower interest rates. However, I would still recommend keeping a 30-year loan and you controlling when you want to pay it off and how you want to pay it off. All right, now let's jump into the I in life. And today we're going to be talking about investing. What kind of market are we in? Is it bull? Is it bear? Well, right now we're in a bear market. What does that mean? A bear market is when there's a 20% reduction or drop off from the peak of the height of the market. So if you look at the S&P 500, right now we're 20% below our last peak, which was in 2024. So, it sucks. We will all wake up, we're looking at our, financial software or our stocks, and you're logging in and you're seeing these big reductions. Mostly if you're retired, think about this. You're retired and I don't know, let's just say you got $1 million that, you're going to live off for the next 15 years of your life. And all of a sudden you wake up, it's 800,000. Doesn't feel good, right? It does not feel good. And I don't think that it has anything to do with, if you're aggressive or assertive or if you invest into the right methods or stocks or whatever. It's not about that. Markets go up, they go down. When they go up, that's what we call a bull market. And right now we're in a bear market. So what do? I think it's times like this where it's like a big reminder that what goes up must come down. However, it'll go back up. But are you able to weather the storm? And did you do what you're supposed to do, which, basic economics 101, which is to diversify. And in a market like this, one of the things that usually happen is real estate slows down a little bit. People see their accounts, it's low. They're like, oh no, what's going on? Based on our market today, a lot of it has to do with the tariffs, Liberation Day, as Trump calls it, where tariffs are getting, placed on different countries to try to bring our economy or to pay down our debt, our national debt, by having other countries pay us taxes on goods that they want to ship here for resale, right? Or for production. And so that's putting a big stump because it's the unknown. People don't know what's going on. So it's affecting a lot of, different things, companies, and our market in general. This is a reminder for all of you that you should be diversifying, whatever it may be, whether it's in commodities like gold, oil, or silver, whether that's, ETFs that you buy online or you buy bricks or bars of gold. It doesn't matter. You need to diversify. And in a market like this, real estate gets a little soft. A lot of people with assets slow down. They're like, okay, let me maybe not buy right now and see what happens. However, for those of you that have the means for it, you should be looking to buy at this point. When everybody backs out, that's an opportunity, in my opinion, for you to jump in. When everybody's ready to buy something or jumping into something or diving, it gets really competitive. And by that time, usually it's too late. Now, again, I want to be very clear about this. It's got to be within your means. So if you're going to go out and buy a property or, diversify into real estate right now, don't do it if it's going to change your life. You're going to not be able to afford doing what your normal lifestyle looks like today. Like, it can't change. And if you're hearing my words. You're like, yeah, I'm going to go take everything that I have and go buy real estate because it's not competitive right now. Not a good idea, right? I'm talking about diversifying what you already have. But what are the benefits of that? Well, let's start with the fact that when people are not buying and it's less competitive and homes are in the market a little bit longer, you probably get a better deal. The interest rate may be a little bit higher. And I have this conversation all the time. Check this out. I want to be really clear about this strategy. When interest rates are high, real estate prices usually are better. Why? Because there's less competition. No one's bidding against you. There's less people in the market because they're all on the sidelines waiting to see what happens. Well, perhaps that's your time to jump in. Let's take a look back at the last 12 years. The last 12 years since 2012, 2013, it's been a seller's market, has not been a buyer's market. It's been a steady stream. Sellers have been in control. There's not been enough inventory, and it's a seller's market. That means that, there's more buyers than there are homes for sale. Low inventory. It's been a problem. But when interest rates drop, that's when all the buyers come out of the woodwork and they all start bidding against each other on home prices. So let's do a quick example. If you were to buy a home that is in a market where interest rates are really low and there's like a lot of people out there trying to buy, and a home's listed for $500,000, but one person makes an offer for $510,000 and the other for $515,000. And the last one for $530,000 and it goes in at $530,000, it just sold $30,000 higher than, the list price or maybe what it was worth. What does that do? Brings up value for that whole neighborhood. And then that neighbor says, oh my goodness, I can make some money. So they list for $530,000 and then they get an offer for $540,000 and then $550,000. And then you got another bidder at $560,000. All of a sudden, in like 1 year, this property just went up $60,000. That is not uncommon when rates are low. We've already seen that happen 2-3 times in the last 12 months. And it's just a lack of inventory, it's supply and demand. So let me ask you a question. Do you want to wait until your monthly payment is ultra affordable and you jump in and buy when the rest of the United States is and pay a higher price? Or marry the home and date the rate? What does that mean? That means you buy a home in today's market, let's say, where rates are a little bit higher. High rates are usually temporary, right? There's no guarantees. I don't have a crystal ball. I make no guarantees. However, I've been doing this long enough, almost 20 years, to know that, what goes up must come down, but it goes up again. And it's just like a little ride that goes up and down. As long as it's within your means, you're good to go, right? Affordability. However, let's go back to my example. If you were looking at a $500,000 home today and rates are high and there's no competition, what if you picked it up for $490,000? In my first example, if there was people bidding and that third person picked it up for $530,000, but you were to buy now at $490,000, that's a $40,000 savings that you would save. Or your payment would probably be $300 higher per month. So let's do that math. $300 a month times 12 months a year. That's $3,600. That bidder that overpaid by $30,000, that would take 8 years to make back up for that amount of money because they were waiting for affordability. So I would rather buy when it's less competitive and when rates are a little bit higher and get a better price on the actual real estate and wait it out so that I could refinance to get a better interest rate. That's what I would do. All right, next, let's talk about the F in life. And today I want to touch on family. As a real estate broker and a lender, you have to imagine, I'm talking to tons of people. And if I look at that over all the years I've been doing this, yeah, you'd be surprised as far as like married couples go, how one person, has control over everything, or the other person has no idea of what's going on. That seems to be more of the case than having a married couple being very fluent about their finances together. This topic could be a little touchy for some, and I feel like I got to touch on this as California real estate broker. I have seen a lot. I may have seen it all, maybe not. I'm always seeing new things. However, I can't believe what I hear or see sometimes. And so I think it's really important to talk about this topic because divorce, I mean, finance is one of the leading, reasons for divorce in America. And I can totally see why. It's when people hide stuff from each other and don't disclose or don't communicate, and they find these big surprises. And don't want to offend anybody out there, mostly if you're one of my clients that I've talked to in the past that are watching this, but wow, the amount of people that actually call in asking for a cash out loan or to refinance, and it starts like this: I would like to refinance. Does my husband or does my wife need to be involved, or do they need to know about this because I don't want them to know? Blows my mind, people. I've been married almost 20 years. I would never start a conversation like that. I mean, how unhealthy is that? I would say that that type of conversation that starts off, I don't know, the hundreds and hundreds of conversations that I've had that started out like that, I wonder if they're still together or not. I don't know. I think it's important, though, to really understand everybody. Your spouse is your partner. And you should be totally communicative. You should be, very, very open with finances with your partner. And you know what? Old school, it's like, oh, this person's better with math or this person's more organized, so they handle everything. Yeah, not a good enough excuse. I think everybody should get involved and just take a look or a peep just to know. And for your own protection or safety, what I do see a lot of too is like, all of a sudden, you've got a married couple, one person does all the books and all the finances, and then they pass away for whatever reason, right? Could have been sudden and not expected. And then all of a sudden, hell breaks loose. And they're trying to dig and find out, like, oh my God, I didn't know we owed this, or I didn't know we have this, or I didn't know you got to get prepared. You have to know what you have. You got to know what you owe. If you're in a community property state, such as here in California, you not only are you partners or 50-50, right? You share assets, you share debts. So if you pass away and you have a bunch of debt, you're passing it on to your heirs or your beneficiaries or to your spouse. You need to talk about this now, whether it's painful or if it's, not, it doesn't matter. You need to be able to speak on it so that you're always prepared. I think that is very healthy. That's very healthy. That's going to make everything a lot better in any type of circumstance. And I'm going to be very clear one more time, in case you were wondering, you cannot do a refinance loan and take cash out of your home without your, husband or wife knowing, if you're both owners on the home, right? There is one conduit. There's one caveat there. If you owned a home before you got married and it's in your name, right? And again, you bought it before you were married. You never added on your spouse. Oh, you have rights. You can do whatever you want on that. That's not what I'm talking about here. I'm talking about you got married, bought a home with your wife or husband. You did it together and you're now trying to take money out of the home without them knowing. That's a big no. Please don't do that. You suck if you do. And it's like time to wake up, talk to each other, do your finances, even if it sucks. You need to start somewhere. Okay, this brings us to the last part of our episode here, the E in life. Today, we're going to be talking about education. This is a fun one. I like this. So I have 4 kids, and one's already in college. Got another one going into college, and then 2 more right behind theirs. Obviously, have money put away, save for college. It's all been planned out. However, just with everything that's been going on, whether it's friends of ours or family or, just people that words like gap year or terms like, oh, I changed my major, so now I'm going to take another 2 years, or, hey, I'm going to take a break, or whatever the reason may be, right? Instead of your standard good old 4-year college, or 4 years of go to college, now it's getting extended. It's going to cost more, whatever the reason may be. Or how about this? They go for 2 years and then something happens in their life and then they quit. And now you've paid for 2 years of college for no reason. Well, here's what I'm doing. I'm making my kids take loans out, right? Nothing's changing. Take a loan out. Obviously, we don't qualify for financial aid, so they're not getting any, money, and neither do I want them to, right? We just don't qualify, so don't need it. But I have them taking out some student loans. Why? Why do you ask? They're taking out loans, and the deal is if you finish in 4 years, right, and you actually complete college and get your degree, then I'll pay for it. The minute you graduate, boom, I'll pay for it. But if you take longer than the 4 years that we agreed on, or if you change majors and you just added on 2 years, or you decide to quit, that's on you. You now owe money to the Department of Education for your education that you bailed on. So why not do that? I mean, there's different types of loans out there for student loans. There's some that don't have any interest and all payments are deferred. So while the student is in school, you do not have to make any payments and it's deferred. So, that makes it easy. There are some loans that have no interest. There are some that accumulate interest. You should look into it. So if you have kids, I highly recommend that you use this model because, your kids have to have skin in the game. It's not a money thing. It's not like I don't want to pay for it. I just think that they got to be vested. And if they are, I know for a fact that their actions, their behavior, what they decide to do or not do, it's going to be way different than mom and dad just covering the bill for every single thing while they have the best time of their life in college or extended high school for some. That's our family's method. I wanted to share that with everybody. Make some comments. Tell me what you think. Tell me if I'm being harsh or if you like it. But that's what we're doing. I hope you can use some of that to think about your kids who are going off to college too. I'm telling you, it's a really good idea. All right, everybody. So that's a wrap of episode number 6 of my podcast, The Facts of Life. As your host, John Doan. If you liked what you heard here, please subscribe or like, and also please make comments. If you have something to say, if you think I'm BSing, if you don't like me, say something. If you do, say something there too. Thank you so much. See you on episode number 7.